Hi, you're watching Russell Market Week in Review for the week ending February 6th, 2015. We're coming to you today from Russell's World Headquarters here in Seattle, Washington. I'm Mark Soupiset, and I'm joined this week by Erik Ristuben, our Chief Investment Strategist. Erik, good morning.
Good morning, Mark.
Thanks for being back on the program. Let's start here in the U.S. where we had a good jobs number to end the week. Tell us about that and what that means for the economy going forward.
Yet another good jobs number. Finished last year adding about an average of 240,000 jobs a month to the U.S. economy. This number was 257.
Okay.
It was a good number.
Yeah, better than expectations.
Better than expectations. And a couple of other interesting and good things happened in that number. Number one, the participation rate actually went up. We've been talking about when the participation rate would go up, if it would go up. It went up by 0.2%. So actually, even though it's a very good jobs number, unemployment rate went up because the participation rate went up. The other nice thing that happened in there, or the thing that is notable that happened in there, is we saw hourly wages go up.
Okay.
And this is the thing we've been talking a lot about, right? When we get closer to full employment, wages start going up because people can get other jobs, and as a result of wages going up, that is going to be the most likely reason the Fed raises rates. We still think they're going to do it in the third quarter of this year, and we think that the indication that we saw from the jobs data today tells us that we're getting closer and closer to that point.
Okay, good stuff. And in those underlying numbers, I think, make that top line jobs number even that much better, right? Because it reinforces that this is really a robust trend that we're seeing as far as how private companies are hiring.
Yeah, it's a sign of a strong economy in a lot of different ways.
Okay, let's shift gears, look at Europe. We had some good economic data there as well. We also saw the ECB sort of send a message to the Greeks about their debt and what they are and aren't going to be doing there as far as loans. Talk about that.
Well, as we know, the newly installed government has been saying things, and it looks like this week some of their European neighbors decided that they would send some messages. And so what the ECB actually told Greek banks was that they would no longer accept Greek debt, sovereign debt, as collateral for loans with the ECB.
Right.
I think that's to kind of begin to try to forestall or stop some of the silly talk that's been going on, maybe about defaults or potential defaults. But yeah, they're also talking about a deal in terms of how does Greece actually work within the agreement and yet not continue to suffer the kind of extraordinarily negative economic environment that they've had.
Okay.
But as he said, Europe had some good numbers, right? PMI solidly, the composite PMI was up this month. The services, the manufacturing. A really interesting number out of Germany was that industrial production, factory production was up 4.2%.
Wow, that's a big number.
Yeah, and again, we've been talking about kind of why we thought Europe was going to start rebounding. One was cheap money, quantitative easing. The other was the euro's cheap, and that factory production number was heavily influenced by exports.
Okay.
Because now all of a sudden, since German goods are made using euros as a cost structure, euros are cheaper, their goods and services are more competitive on the global market. We saw the other side of that in the US number, the GDP number last week, where the GDP, the exports in the United States were down, very likely to a strong dollar, up in Germany because of a weak euro.
All right. Let's wrap up in Asia, where we saw China lower its reserve requirement to stimulate the economy. What's your guess on what that's going to mean as we go forward there?
Well, this is kind of a continuation of our theory, right? That the U.S. would maintain economic strength, that Europe would begin to rebound, and that China would kind of do everything it can and necessary to create a 7% growth number. And I think this is all about China trying to fine-tune its economy for that kind of 7% growth rate. They saw obviously some little weakness that they'd rather not have, and so they tried some other ways of stimulus, but they didn't seem to be catching hold. So they go to the reserve requirement, which should actually potentially could inject 2 to 3 trillion yuan into the system.
Okay.
So it's a non-trivial move, but it's part of a series of moves that indicates that China is trying to actively manage their economy for a reasonable growth rate, not an extraordinary one, but certainly not a low one.
Okay, we'll keep an eye on that. Erik, as always, thanks for your time.
You bet.
And your insights. We appreciate them, and we appreciate you joining us this week. We'll see you next week.